If you're trying to understand what's happening in the markets right now by watching stock market headlines, Federal Reserve press conferences, or financial TV, you're already looking in the wrong place. The most important shift in the global financial system today is not showing up in the S&P 500. It's not being explained by earnings reports, and it's definitely not being captured by inflation numbers on the evening news. In fact, the biggest signal is coming from a place most people have been trained to ignore. Gold and silver are not going up because of hype. They're not rising because of fear, and they're not moving because investors suddenly became emotional. They're repricing something far bigger. What's happening right now looks uncomfortable. It feels unfamiliar, and it doesn't fit neatly into the stories most Americans have been told about how money is supposed to work. But here's the key idea most people are missing. This is not a trade. This is not a cycle, and it's not a temporary distortion. It's a reset in how value is being measured. And once you see it through that lens, a lot of things that look confusing suddenly make sense. Stay with me, because once this clicks, you won't look at markets the same way again. Most Americans are still being taught to look at the economy through a very narrow lens. They're told to watch the stock market. They're told to track CPI. They're told that if unemployment is low and GDP is growing, everything must be fine. But that framework misses the real story. The real issue isn't whether the economy is growing. The real issue is what that growth is built on, and what's quietly breaking underneath it. Mainstream financial narratives treat money as something stable. They assume dollars today are roughly equivalent to dollars 10 years ago. They assume bonds are safe because they always have been. They assume pensions, Social Security, and retirement accounts will adjust automatically. But those assumptions only hold in a system where the currency itself is stable. What we're living through now is not a typical boom and bust cycle. It's a structural transition. The United States has reached a point where debt can no longer be allowed to shrink. Interest rates can no longer stay high without breaking something. And promises already made to retirees, to bondholders, to public workers cannot be honored without expanding the money supply. That changes everything. When money itself becomes the pressure valve, traditional metrics lose meaning. Stock prices can rise while purchasing power falls. Wages can increase while living standards decline. Retirement accounts can grow on paper while buying less in real life. So when people ask, why are gold and silver moving like this? They're asking the wrong question. The better question is, what are these metals measuring that the rest of the market is hiding? To answer that, we need to step away from opinions and headlines and look directly at the data. Let's ground this discussion in verifiable data and timelines, not opinions. Over the past several years, a few measurable trends have emerged that help explain what we're seeing in gold and silver today. First, real interest rates. When you subtract official inflation from short-term U.S. Treasury yields, real rates have spent long stretches either near zero or negative since the early 2000s. Historically, that environment has coincided with strong performance in precious metals. The reason is simple. When cash and government bonds fail to preserve purchasing power, investors look for alternatives that don't depend on a promise to pay. Second, Federal Reserve balance sheet policy. After tightening policy in 2018, the Federal Reserve reversed course in 2019 and resumed expanding its balance sheet. That expansion accelerated sharply in 2020 and, despite periods of tightening, has remained structurally elevated compared to pre-2008 levels. Balance sheet expansion increases liquidity in the system and reduces the long-term purchasing power of the currency. Third, U.S. government debt dynamics. Federal debt has risen from roughly $23 trillion in early 2020 to well over $34 trillion today. At the same time, interest expense on that debt has become one of the fastest growing line items in the federal budget. Higher rates make that burden worse, not better, which creates ongoing pressure to keep rates contained. Fourth, currency performance. The U.S. dollar index peaked in 2022 and has since experienced meaningful declines. Historically, major tops in gold and silver have occurred only after extended periods of dollar weakness, not at the beginning of those moves. Fifth, central bank behavior. According to publicly available reserve data, central banks have been net buyers of gold at the highest levels seen in decades. This includes countries that had not meaningfully added to gold reserves for many years. These purchases are not speculative trades, they are strategic balance sheet decisions. Finally, supply and demand fundamentals. Gold mine supply has grown slowly, while silver supply has remained constrained as industrial demand has increased. In multiple recent years, silver demand has exceeded new supply, creating persistent deficits that must be filled from above-ground inventories. None of these data points on their own tell a complete story, but taken together, they describe a system under pressure, one where traditional financial instruments are increasingly dependent on continued monetary accommodation. The next step is understanding what these facts may imply when viewed as part of a larger system. When we step back and look at these facts together, a broader pattern begins to emerge. This pattern suggests that precious metals may not be responding to short-term market sentiment, but rather to long-term constraints within the financial system itself. One possible interpretation is that policymakers are becoming increasingly limited in their choices. High interest rates help contain inflation, but they also increase government borrowing costs and stress debt-heavy sectors of the economy. Lower rates reduce that pressure, but at the cost of weakening the currency over time. This creates a narrow corridor where policy can operate without triggering instability. Another interpretation is that markets are beginning to price in these constraints ahead of official acknowledgement. Gold in particular has historically acted less like a commodity and more like a barometer of confidence in monetary management. When trust in policy durability declines, gold tends to reflect that shift earlier than most financial assets. Silver may be responding to a similar dynamic, but with an added layer. In addition to its monetary role, silver plays a growing part in industrial applications, including electronics, energy infrastructure, and defense-related technologies. That dual role means silver prices can react both to monetary pressures and to physical supply constraints. From a strategic standpoint, this suggests that different groups may be responding in different ways. Central banks appear to be diversifying reserves away from exclusive reliance on fiat currencies. Institutional investors may be reassessing the role of bonds in portfolios that were designed for a lower debt, lower inflation world. Meanwhile, individual investors may be searching for assets that are not directly tied to policy decisions or political cycles. None of this guarantees a straight line upward for precious metals. Markets rarely move in clean, uninterrupted trends. Periods of consolidation or correction would be consistent with historical patterns, even within longer-term bull markets. However, what seems increasingly unlikely is a return to the pre-2008 financial environment, one characterized by stable debt levels, positive real yields, and minimal central bank intervention. If that environment no longer exists, then asset pricing models built for it may no longer apply. This doesn't mean collapse is inevitable. It does mean adaptation is underway. And when systems adapt under pressure, capital tends to migrate toward assets perceived as durable, scarce, and politically neutral. Understanding how those shifts affect the broader system is the next step. When shifts like this occur, they don't stay contained within a single market. They ripple outward. If confidence in traditional stores of value continues to weaken, the effects spread across financial systems, governments, and global relationships. In financial markets, this can show up as increased volatility and changing correlations. Assets that once moved together may begin to diverge. Bonds, which for decades served as a stabilizing force in portfolios, may lose some of that role if inflation and currency risk become dominant concerns. At the same time, alternative assets that historically sat on the sidelines may take on a more central role. For banks, prolonged periods of low or negative real rates compress margins and increase reliance on leverage. Rising asset values can mask underlying balance sheet risks, but only temporarily. History shows that stress often emerges not during expansion, but when liquidity conditions shift unexpectedly. For governments, higher debt levels reduce flexibility. Fiscal decisions become more constrained, and monetary policy increasingly serves as a tool to manage those constraints rather than purely economic objectives. Over time, this can blur the line between fiscal and monetary authority, raising questions about long-term currency stability. At the currency level, persistent money creation tends to weaken purchasing power. While this process is often gradual, it can accelerate during periods of crisis or political pressure. When multiple major economies follow similar paths, the result is not a strong alternative currency, but a generalized search for neutral reference points. On a global scale, this dynamic can influence geopolitical relationships. Countries that rely heavily on foreign reserves may seek diversification. Trade agreements may begin to emphasize settlement mechanisms outside traditional channels. Trust becomes more fragmented and financial alliances more fluid. None of these outcomes require dramatic headlines to unfold. They can develop quietly over years. And that's what makes them difficult to recognize in real time. By the time changes become obvious, much of the repricing has already occurred. Which brings us to the most important question for individuals. How does all of this translate into everyday life? At this point, it's fair to ask, okay, but what does any of this actually mean for me? Because if these ideas stay abstract, people tune out. The reality is that systemic shifts don't announce themselves with a single event. They show up in daily life, slowly, in ways that feel disconnected at first. You notice it when savings don't stretch as far as they used to, even though your account balance looks higher. When the cost of insurance, healthcare, housing, or education rises faster than wages. When investment returns feel harder to come by, and volatility becomes the norm rather than the exception. For workers, this can mean more job uncertainty during economic slowdowns, even when the official data says the economy is strong. For retirees, it can mean that fixed income doesn't feel so fixed anymore, as purchasing power erodes quietly over time. For families, it can mean long-term planning becomes more difficult, because the assumptions that once felt safe no longer hold. This is especially relevant in the United States, where many people rely heavily on financial assets for retirement. 401s, Ks, pensions, and Social Security are all tied, directly or indirectly, to the health of the broader financial system and the currency it runs on. When that system is under pressure, the risk isn't always a sudden crash. More often, it's a slow loss of confidence, a sense that the rules are changing, but no one is quite saying it out loud. That's why understanding the bigger picture matters. Not to panic, not to predict exact prices, but to recognize that protecting financial stability today may require thinking differently than it did 20 or 30 years ago. And that leads to the question of mindset, the framework you use to interpret what you're seeing. To make sense of environments like this, I use what I call the structural lens. It's a way of thinking that ignores short-term noise and focuses on what systems are forced to do over time. The structural lens starts with a simple question. What choices are no longer optional? For governments, servicing debt is not optional. For central banks, maintaining liquidity is not optional. For pension systems, paying promised benefits is not optional. When obligations can't be reduced, the system adapts somewhere else. Under this lens, you don't ask, is inflation going up or down this month? You ask, can this system function without expanding the money supply? You don't ask, will markets go up next quarter? You ask, what assets depend entirely on confidence and which exist outside it? The structural lens also separates price from value. Price moves fast and reacts to headlines. Value changes slowly and reflects long-term constraints like scarcity, durability, and independence from political decisions. This framework doesn't predict exact outcomes. It doesn't claim certainty. What it does is filter information. It helps you distinguish between temporary volatility and permanent shifts, between noise and signal, between narratives designed to reassure and realities that quietly reshape incentives. Once you adopt this lens, market behavior stops feeling random. You begin to see why capital moves where it does, not because of emotion, but because of pressure. And when pressure builds long enough, systems don't debate. They adjust. Your cue, say tip to move on to 8 practical value section. Tipper. Continuing. 8 practical value section. 300 to 350 words, real-world usefulness, no investment advice. So how do you actually use this way of thinking in real life? Not to chase trades, not to predict prices, but to reduce regret and improve resilience. First, focus on exposure, not forecasts. Instead of asking, what will gold or stocks do next? Ask, what am I most exposed to if this system continues in its current direction? Many Americans are heavily exposed to a single currency, financial assets that rely on low rates, long-term promises funded by future growth. There's nothing inherently wrong with that, unless the system those promises depend on becomes unstable. Second, think in terms of balance, not perfection. You don't need to be all in on any single idea to benefit from it. The goal isn't to be right on every move. It's to avoid being wrong in a way that permanently damages your future options. Third, separate liquidity needs from long-term protection. Money you need soon should behave differently from money meant to preserve purchasing power over decades. Confusing those two roles is one of the most common financial mistakes people make, especially during periods of change. Fourth, observe policy actions more than policy statements. What matters is not what institutions say they intend to do, but what they are forced to do when trade-offs appear. Rate cuts, balance sheet expansion, and emergency measures tell you more than any press conference ever will. Finally, stay adaptable. Systems evolve. New constraints emerge. Assumptions that worked in one decade may quietly fail in the next. The advantage doesn't come from predicting the future perfectly. It comes from recognizing when the environment has changed and adjusting before you're forced to. And that brings us to the most important takeaway of all. If there's one thing I hope you take away from this, it's not a price target or a prediction. It's awareness. We're living through a period where the rules that shaped the last few decades are being quietly rewritten. Not all at once. Not dramatically, but steadily. Most people won't notice it as it happens. They'll feel it later, when outcomes don't match expectations. Understanding this isn't about fear, it's about clarity. Clarity that financial systems are under pressure. Clarity that long-term promises require long-term stability, and clarity that protecting your future may require thinking beyond the frameworks you were taught. You don't need to panic. You don't need to act impulsively, and you don't need to abandon everything you've ever believed. But you do need to pay attention. Because the biggest financial shifts rarely announce themselves as emergencies. They unfold quietly while most people are distracted by noise. And those who recognize them early don't gain an advantage by moving faster. They gain it by thinking differently. That's how lasting financial resilience is built. Not through prediction, through perspective.